You want to know and follow this and figure out just how blatantly obvious all of this is, you have to start where it all started, in 2009, after the financial crisis. What you're seeing going on today is the long-term effects of the Sustainable Growth Plan that was outlined from the OECD, which is the writer of this document that we're going to be looking at. Sources here, you're welcome to download this and go to the source if you want. Basically, the OECD is a unique forum where the governments of 30 democracies work together to address the economic, social, and environmental challenges of globalization. The OECD is also at the forefront of efforts to understand and to help governments respond to new developments and concerns such as corporate governance, which we see a plethora of in today's environment, the information economy, which we see rapidly changing in today's environment, and the challenges of an aging population. The organization provides a setting where governments can compare policy experiences, seek answers to common problems, identify good practice, and work to coordinate, keyword, domestic and international policies. As policymakers work to stabilize financial markets and strengthen short-term demand, they can leverage the crisis to build the foundations for stronger long-term growth. So what do you do now? Short-term funding for longer-term obligations. That's exactly what we're seeing in the repo. Now, the repo got created in 2013 by the Fed, and we had a debt ceiling crisis just like we had last year in 2012. Now, many of the stimulus packages being introduced in OECD countries at this time, 2009, include components to support innovation, entrepreneurship, infrastructure, human capital, and green investments to foster more efficient and sustainable economic growth. So everyone wants to talk about this all the time, globalization, but as soon as you bring up the fact that countries might be working together on a financial standpoint, they can't handle it. That's what globalization is. It is cooperation for sustainable global economic growth. Now we're going to segue to the OECD strategic response to the financial and economic crisis written in 2009. Contributions to the global effort. There's your link right there. Forward. The world is facing the severest economic crisis in decades, affecting families and communities across the planet. Now, the decades they're referring to is the last one before this, obviously 1987, crash related to the Salomon bond scandal. The financial system is paralyzed, and restoring stability, confidence, and growth is the priority. I'm telling you right there. Stability, confidence, and growth. The OECD is working with the world's governments. And other organizations to overcome the crisis and get our economies moving again. We must also begin shaping the world economy of tomorrow to make it stronger, cleaner, and fairer. We need healthy financial markets for our prosperity and development, but we also know that business as usual is not an option. Any effective strategy requires major new thinking about regulation and markets. Basel III, still not done. Basel III, still not done. About accountability and ethics. We need rules of the game based on a better balance between markets and governments. It is about greater coordination, and building global institutions for our time. What have you seen lately? Global institutions. You have Fidelity all around the world. You have BlackRock all around the world. State Street. All of these big players are now internationally relevant. Now, we have to restore the conditions for growth driven by innovation, trade, and investment. We must do Doha. Notwithstanding the immediate crisis, we must also apply new thinking to tackle climate change and poverty. What's been in the news for the last 6 years? Climate change. These things literally have been taking shape over the last decade. They tell you what they're doing. Sharing the benefits of prosperity and opportunity and ensuring fair social protection are also key to restoring trust in the system. The OECD strategic response points the way forward through action and cooperation. Our thinking is always evolving, but our commitment to building a stronger, cleaner, and fairer global economy is unchanged. Now, key things from here. The OECD is working with the world's governments and other organizations to shape the world economy of tomorrow. They're requiring major new thinking about regulation, Basel III, the CAT and MS, all that fun stuff about accountability and ethics, reporting requirements, all that jazz. It's all happened. We have to restore the conditions for growth driven by innovation, trade, and investment. We saw that happen in 2020. Now, the OECD strategic response. The OECD strategic response, which was developed with the collective inputs of the OECD Council, the committees, aims both to address the crisis and to seize the opportunity to build a stronger world economy. For decades, the OECD has advised member countries and helped coordinate their policies. The organization's coverage of a wide range of policy issues directly relevant to the current crisis and its focus on medium-term responses and long-term solutions to policy challenges are unique strengths. Our analysis suggests a focus on two priority areas. Number one, finance, competition, and governance. In the context of regulatory reform in financial markets, the OECD provides an institutional framework for an ongoing dialogue between different policy committees, focusing on areas where it has leadership, such as transparency, corporate governance, competition, tax pensions, and financial education, as well as the interaction of policy with institutional and market structures and the overall consistency and efficiency of reforms. Now, what applies to that definition? What applies to areas where it has leadership, transparency, corporate governance, competition, tax, pensions? What instrument in the market has all of those things? Money market funds. They report monthly. They just got reformed. They have a business with the Federal Reserve. They have transparent reporting requirements. They have corporate ESG requirements. They have competition requirements. They have taxes, and they hold pension funds. What else could you want? Now, the OECD will continue to work on strengthening and implementing principles and guidelines in these areas, which they have done. Deliverables will also include inputs for the review and improvement of national policies, as well as better policy coordination at the international level. Now, the focus will be on fostering the conditions for effective and appropriate regulations and identifying areas where there may be regulatory gaps. Number two, second area of concern or priority, restoring sustainable long-term growth. Building on the OECD's expertise on structural issues and whole-of-government approaches to policy making, and on the OECD's long-standing work on open markets, employment, the environment, and innovation, the OECD will monitor developments and identify policy options and recommendations for putting countries back on a path of sustainable growth. Such strategies should ensure that recovery is based on low-carbon paths to growth, on eco-innovation, and on knowledge creation, all with a more equitable society that spreads opportunity and extends protection to the most vulnerable. A key contribution will be forward-looking analysis and guidance to assure a healthy balance between governments and markets, and to define exit strategies for governments to withdraw their intervention in the private sector, which you're about to see happen with the Federal Reserve once we reach the post-crisis phase, which is what we're about to be entering into. Now, balancing markets and policies and fostering exit from public ownership. We're going to go into a little bit more on that one. Now, this is where it gets interesting. Coordinated fiscal stimulus has been an important part of the short-term actions to address the crisis. The immediate response has seen a major injection of public resources into the private sector, either directly through liquidity support or outright public capitalization of banks and financial institutions, or indirectly through increase of use of public subsidies and guarantees. However, it must be kept in mind that such massive intervention could produce very undesirable consequences in the medium run by distorting the incentive structure for households, firms, and financial intermediaries, and by threatening to detonate protectionist and or anti-competitive reflexes that could harm businesses and incite retaliation. It could also distort the structure and size of government budgets and debt, which is exactly what's happened, endangering fiscal sustainability and reducing resources for long-term growth, as social protection costs rise and incoming revenue weakens due to the downturn. These risks will need to be countered effectively, balancing short-term and long-term objectives. That's all it's been about. Coordination of fiscal stimulus, injection of public resources into the private sector. Exactly what's happened. Now, delivering on this response, the OECD, I can't say that today. The OECD's strategic response is based on a cross-cutting and holistic view of the different policy areas and government actions involved in making markets work efficiently. It will mobilize the OECD's vast global network of experts and national policymakers to generate relevant analysis and recommendations. Implementation and monitoring of the strategic response will lie with the respective communities, who will approve and provide guidance in the regular committee process. Work will be carried out with close cooperation and under joint prospects between committees and directorates. Emerging and developing economies will be welcome as standing partners in the efforts to define collective solutions. Now, in essence, this has all been fucking planned for over 10 fucking years. This is the financial crisis response. You are living through it still to this day. You are still living in the response to the 2008 crisis. And it's all been about globalization through coordination, which is exactly what you've seen. So just pause the brakes for a second. What happened in 2020? Supplemental leverage ratio. What happened? The interfund lending market died during COVID. SEC passed relief that allowed funds to lend to each other, which is what you see going on in today's 13Fs. Then you see, at the same time we're leveraging with supplemental leverage ratio, what's happening in China? They are deleveraging. This is where the term yin-yang comes from, because it's financial coordination to balance out the global financial market, financial system. And if you have one country leveraging and another country deleveraging in an overlapping period, that is the definition of cooperative and coordinated international monetary policy, which is exactly what you've seen going on. So this is just one sliver of information that points to the right direction, but I feel like this was a good way to get you started on looking at the right area. And where you got to look is here. The OECD, all of these frameworks and policy guidelines in response to the 2008 crisis, we've been living through it for the last 10 years. That's what this shit is. And it's all here. And, you know, I've got this shit mind mapped out. Let me go to it real quick. It's so, I mean, a lot goes into it, but the entire thing is very, 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 very similar as far as the overall goals. Those have not changed. There's just different ways to go about it, but the overall goals have not changed. Long-term sustainable growth. You have LIBOR to SOFR, unsecured to secured lending, and the flash crash of 1987 or whatever they're referring to in that document. This is what we're looking at here. This is the decisions that have gone into where we are today. Now, where I started in that document was the result of all this. All went into the 2008 crisis. You have Salomon Brothers' fearsome foursome IPO partnership in the 1970s. You have Gary Gensler's twin brother Rob Gensler working at Salomon. You have John Lipsky, all the alumni from Salomon, or people like Tom Miglis, who helped Citadel, Ken Griffin get on its feet with the technology. Myron Scholes, who was the Nobel Prize winner for the Black-Scholes model for derivatives, which were a primary cause in monetary policy response. Which, in the monetary policy response, from the Fed side, we had three things. Open market operations, tool set number 3. Credit, tool set number 2. And tool set number 1, which is liquidity. We had monetary policy response. All these three things went into that. And from this, you get things like lower interest rates. You get purchase agency mortgage-backed securities to respond. You get commercial paper funding facility, asset-backed commercial paper money market mutual fund liquidity facility, term securities lending facility, primary dealer credit facility, discount window, crisis-related term auction facility. It's all been macroeconomic policy response. You have the seasonal credit program, primary credit program. You have primary dealers that are increasing Fed liability. It's all been happening. Sorry, this all got jacked up. I gotta fix this. But it's not a lot that's going into it as far as an overall goal. It's just a lot of decisions that they've had to do to make this shit happen. How do you kick $400 trillion worth of LIBOR products into the sunset and not worry about it? You lock the country down, you give everybody stimulus like they just told us they were going to do, and you call it COVID-19. That's how you do it. So let's go, Brandon. That's the introduction.